Have you ever wondered if there's a secret to getting that dream home with a payment that feels almost too good to be true? You scroll through listings, you see the rising prices, and you feel that familiar knot in your stomach. The dream of owning a home, of having a place that's truly yours, feels like it's slipping further and further away. Then, when you're feeling most discouraged, some folks in the banking world will whisper a little secret in your ear. They'll lean in, smile reassuringly, and tell you there's a special product just for people in your situation. It's a concept that sounds like a magic trick for your budget. The 50-year mortgage. That's right, half a century. A loan that will likely outlive your career, and maybe even you. The sales pitch is smooth and incredibly tempting. They'll show you how you can afford more house for less money each month. Suddenly, that bigger home with the extra bedroom or the nicer yard seems within reach. It's presented as the smart, safe path to homeownership. A clever financial tool to ease the strain and finally get you the keys to your own front door. But I'm here to tell you this idea isn't just wrong. It's a dangerous financial myth, a trap designed to keep you broke for a lifetime. And that's not my opinion. It's a mathematical certainty. The notion that a longer loan term is safer is one of the most pervasive and damaging money myths out there. It's a slow poison for your finances, quietly draining your wealth for decades, year after year. It leaves you with little to show for your hard work, but a mountain of interest receipts and a shocking lack of equity. Think about that for a second. You're not just paying for a house, you're paying for the money to buy the house. And the longer you take, the more that money costs you. Your single largest purchase, the cornerstone of your financial life, could be structured to benefit the lender far more than it benefits you and your family. Today, we're going to bust this myth wide open. I'll show you the simple, undeniable numbers that the banks hope you never look at closely. I'll give you clear, actionable steps to avoid this trap and make a smarter choice. And most importantly, I'll show you how to use your home as a tool to build real, lasting wealth, not a 50-year ball and chain. Now, let me be clear. This isn't about shaming anyone who has considered this path. The world is throwing a lot at you right now. The pressure to buy is immense, and the headlines are intimidating. I get it, I really do. A low monthly payment feels like a life raft in a sea of rising costs, a moment of breathing room in a tight budget. But some life rafts have holes, and this is one of them. Let's learn how to spot them. But that life raft has a hole, and it's slowly sinking your financial future. That easy payment comes at a staggering price. Paid in, lost years, lost opportunities, hundreds of thousands of dollars in extra interest. This isn't a shortcut to the American dream. It's a detour that can last a lifetime. So stick with me. We'll walk through this step by step, using simple examples and real-world stories. You'll see exactly how long-term loans are structured to work against you, and why a shorter-term mortgage is the most powerful wealth-building tool you have. By the end, you'll understand the danger, and you'll have a clear, hopeful plan to make your home a blessing, not a burden. Let's get to it. Your financial freedom is too important to leave to chance. Your future self will thank you for taking the time to learn this. So, what exactly is this thing, this 50-year mortgage? It's a financial product that's been quietly lurking on the fringes of the lending world, but it's starting to get more attention, especially as housing prices climb. At its core, it's exactly what it sounds like. A home loan that you agree to pay back over the course of 5 decades. That's half a century, folks. 599 payments after your first one. To put that in perspective, if you take out one of these loans at age 30, you could still be making mortgage payments at age 80. You heard me right. You could be planning your retirement party and your mortgage payment in the same month. Your grandchildren might be helping you budget for it. The primary selling point, the big hook lenders use, is that by stretching the loan term out over such a long period, your required monthly payment becomes significantly smaller. Compared to a traditional 30-year loan or an aggressive 15-year loan, the monthly cash outflow for a 50-year mortgage looks much more manageable. On the surface, this sounds wonderful. Who wouldn't want a lower monthly bill? Especially in today's economy, where every dollar counts. It feels like breathing room. It feels like you can finally afford the house you've been dreaming of without having to eat rice and beans every night. Your bank statement looks a lot healthier, and the immediate stress on your budget is reduced. It's the key that seems to unlock a door that was previously bolted shut by high home prices. This is the shiny lure they dangle in front of you. They sell you the payment, not the total cost of the loan. They focus on the how much per month instead of the how much in total. But here's the thing they don't put in the brochure. You are signing up to be in debt for the majority of your adult life, and you will pay an astronomical amount of interest for that privilege. Because you're paying the loan off so slowly, you build equity at a glacial pace. For the first decade, or even longer, your payments are almost entirely interest. Think about the timeline. 50 years is an incredibly long time to be tied to a single financial obligation. Consider all the life that happens in that span. The world will change, technology will evolve, and your own life will look completely different. You might change careers multiple times, move to a different city for a new opportunity, have children, watch them grow up and have children of their own. Through all of that, this one payment, this one debt, remains a constant fixture in your financial life. Through all of those life changes, that mortgage payment will be there, a constant companion. The problem is, for the first couple of decades of a 50-year loan, your payments are almost entirely going toward interest, not the actual loan balance. You're spinning your wheels, paying the bank for the right to borrow their money, while your ownership stake in your own home grows at a snail's pace. This structure is designed to maximize the lender's profit, not your financial well-being. The longer they can keep you on the hook, the more interest they collect. It's that simple. They are betting that you will be so focused on the low monthly payment that you won't look at the total cost column on the disclosure form. They are counting on you to value short-term comfort over long-term freedom. But you're smarter than that. Understanding this basic structure is the first step toward rejecting this bad deal and choosing a path that actually puts you in control of your money and your future. Let me tell you about a real person a friend of mine will call Sarah. When Sarah was in her early 30s, she was eager to buy her first home. She was single, had a decent job, but lived in a market where prices were high. The bank approved her for a loan, but the payment on a 30-year mortgage felt tight. Then the loan officer presented another option, a 50-year mortgage. The monthly payment was a few $100s lower. Suddenly, the house she wanted seemed comfortably within reach. She felt smart, like she had found a clever loophole. She signed the papers. She moved in, feeling a huge sense of relief and accomplishment. For the first few years, everything was great. Her payment was manageable. She was a homeowner. But then, life happened. She met her husband. They had their first child. The starter home felt a little cramped. A few years later, a fantastic job opportunity came up for her husband in another state. It was time to move. They had been in the house for nearly 10 years. They had faithfully made every single payment on time. They assumed they would have built up a nice chunk of equity. That's when the ugly truth hit them. They opened the lender statement showing their remaining loan balance. Sarah was horrified. After a decade of payments, they had barely made a dent in the principal. Tens of thousands of dollars had gone to interest. They had so little equity that after paying the realtor's commission and closing costs, they would walk away with almost nothing. They were trapped. They couldn't afford to sell the house, but they also couldn't pass up the job. They ended up renting out their old house. They became reluctant long-distance landlords. That came with its own headaches and expenses. Sarah's story isn't unique. She felt like she had worked for 10 years just to pay the bank. She had nothing to show for it. She felt stuck, her options limited by a past decision. The low payment that once felt like freedom became the bars of a financial cage. This is the human cost of the 50-year mortgage myth. It promises security but delivers stagnation. Stolen dreams. All right, let's push the stories and theories aside for a minute and look at the cold, hard numbers. This is where the myth of the affordable 50-year mortgage completely falls apart. Math doesn't have an opinion, and it doesn't care about a good sales pitch. It just tells the truth. Let's use a simple, clear example. Imagine you're buying a home and you need to take out a loan for $200,000. Assume a fixed interest rate of 4% on either loan. First, let's look at a standard 30-year mortgage. Monthly principal and interest, about $955. If you make that payment every month for 30 years, total paid, $343,739. Total interest paid, $143,739. Now, let's compare that to the so-called better option, 50-year mortgage. Monthly payment drops to about $763. That's a savings of $192 a month. Extra family dinner out. Contribution to a savings account. Less stress on your budget. But hold on, let's look at total cost. Paying $763 monthly for 50 years, total paid $455,854. Total interest paid $255,154. You pay $112,115 more in interest. To really understand why the 50-year mortgage is such a wealth destroyer, you have to understand how loan amortization works. Amortization is just a fancy word for how your loan payments are broken down over time. Principal is the money you actually borrowed. Interest is the fee you pay to the bank. With very long mortgages, early payments are heavily front-loaded with interest. The bank always gets its money first. Think of it like this: each payment is a slice of a pie. In the first years of a 50-year mortgage, the interest slice is huge. The principal slice is a tiny sliver. For example, $200,000 at 4%. First monthly payment $763. About $667 goes to interest. Only about $96 reduces your debt. You wrote a check for $763, but your balance drops by less than $100. You are essentially renting money from the bank. This pattern continues for decades. You spend a long time treading water, paying interest without building ownership. Sarah felt like she had nothing after 10 years. She didn't. She had been paying the bank, not buying the house. Equity is home value minus what you owe. It's the part you truly own, a key source of family wealth. With a 50-year loan, equity builds at a glacial pace. Beyond the staggering amount of interest you'll pay, a 50-year mortgage is loaded with hidden risks that can turn your dream home into a financial nightmare. These are things the loan officer won't volunteer, the fine print of real life. The first major risk is your lack of equity. You build equity incredibly slowly. That becomes a massive problem if home prices stagnate, or, even worse, fall. If the market dips, you can end up underwater, owing more than your house is worth. That's a terrible position. Being underwater chains you to your property. If you need to sell because of a job change, or because your family grows, or due to a divorce, you can't without bringing a big check to closing. You're trapped. Refinancing to a better rate becomes nearly impossible. Banks won't refinance loans larger than the home's value. You're stuck with your original loan, unable to move or take advantage of better market conditions. Low equity in the early decades leaves you zero flexibility and exposes you to huge financial risk. Now that you've seen the dark side of the 50-year loan, let's talk about the bright side. Let's talk about the right way to use a mortgage, not as a lifelong burden, but as a short-term tool to build lasting wealth. This is where shorter-term loans, like the 15-year fixed-rate mortgage. I know what you're thinking. Dave, the payment on a 15-year is so much higher. I can't afford that. I hear you. It does require more discipline and maybe buying a little less house. But I want you to see what you are buying with that higher payment. Your freedom. Let's go back to our $200,000 loan example. On a 15-year mortgage at a 4% interest rate, the monthly payment would be about $1,479. Yes, that is significantly more than the $763 payment on the 50-year loan. But look at the magic that happens. Over the 15-year life of the loan, you will pay a total of $266,288. That means your total interest paid is only $66,288. Compare that to the $255,854 in interest on the 50-year loan. By choosing the 15-year path, you keep an extra $189,566 in your pocket. Okay, so you're convinced that a 50-year mortgage is a terrible idea. That's a huge step. But what if you're feeling stuck, and the payment on a 15-year or even a 30-year loan seems out of reach? Don't lose hope. You have plenty of smart, practical options. The key is to shift your mindset from, how can I get the lowest payment, to, how can I pay this thing off as fast as possible? The first and most powerful alternative is to increase your down payment. Saving up a larger down payment before you buy is a game changer. Putting down 20% or more on a home accomplishes several things. First, it reduces the total amount you have to borrow. That lowers your monthly payment and total interest. Second, it often allows you to avoid private mortgage insurance. Avoiding PMI can save you hundreds of dollars each month. It might mean you have to wait another year or two to buy, but that discipline will pay off for decades to come. Don't let impatience drive you into a 50-year trap. We've covered a lot of ground, and we've busted the myth that a 50-year mortgage is a smart or safe choice. You now know the truth. Low monthly payment is a bait and switch. That leads to a lifetime of debt and massive amounts of lost wealth. It's a trap that keeps you working for the bank instead of your own future. The good news, you don't have to fall for it. You have the power to make a different choice, starting right now. It doesn't require a finance degree, just a decision to take control. Here are 3 simple, actionable steps you can take today. First, run the numbers for yourself. Don't just take my word for it. Find any online mortgage calculator. They're free and easy to use. Plug in the price of a home you're looking at, plug in a realistic interest rate, compare a 15-year term, compare a 30-year term, compare a 50-year term. Look at the monthly payment, but more importantly, look at the box that says total interest paid. Seeing the hundreds of thousands of dollars in difference with your own eyes is a powerful motivator. Now, let's move from theory to action. This simple exercise will solidify everything we've talked about and arm you against any slick sales pitch you might hear. It's about making a few small, tangible commitments that will fundamentally change your financial trajectory. Second, if you are a homeowner, commit to making one extra principal payment this year. Just one. This single action is incredibly powerful because every extra dollar you send to the principal is a dollar that the bank can no longer charge you interest on for the next 10, 20, or 30 years. You can do this by adding a small amount to your payment each month. Just look at your statement, find the principal portion of your payment, divide it by 12, and add that amount to every check you write. Or you can save up and make one lump sum payment. Maybe it's from a bonus, a side hustle, or a tax refund. Just be sure to clearly label it for principal only when you send it in. If you're not a homeowner yet, your commitment is just as crucial. Start a dedicated down payment plus fund. Aggressively save not just for your down payment, but for the goal of getting into a 15-year mortgage. This isn't just a down payment fund, it's a 15-year mortgage fund. The name itself changes the goal and raises the stakes. Every extra $1,000 you save now could save you $10,000 in interest later. This single action, whether you're paying extra or saving more, immediately shifts you from a passive debtor who simply sends the bank what they ask for to an active wealth builder who is strategically attacking debt to build equity faster. Third, and finally, make a conscious decision to value freedom over comfort. This is a mindset shift. It's the most important piece of the puzzle. It's about choosing the delayed gratification of a paid-for house with all the peace and options that provides, over the instant gratification of a slightly fancier house with a low payment that stretches out for 30 years. It's about deciding that you want to be the one in control of your income in your 50s and 60s, not the bank. It's choosing to own your future outright, rather than renting it from a lender 1 month at a time. Talk about this with your spouse. Dream together about what life would look like with no house payment. What could you do? How would you feel? Get on the same page. When you know your why you want to be debt-free, the how becomes so much easier. The sacrifices don't feel like sacrifices. They feel like investments in your own freedom. You don't have to be perfect, but you do have to be intentional. There will be months you can't pay extra. Life happens. The goal isn't perfection, it's progress and a persistent, forward-moving direction. Small, consistent steps taken over time will lead you to a future of financial peace. It's the steady drip of water that eventually carves a canyon. Your consistent, intentional choices will carve a path to a debt-free life. You can do this. You have what it takes to change your family tree. Start today. Make the commitment.